Good morning. I'd like to officially welcome all of you to our first REBI Think Tank session entitled, What's Driving Insurance Up and Why? My name is Arlene Kim Kawamoto, and I am the Hawaii REBI chapter president this year, and as well at your MC. Before we get started, I'd like to first give a big mahalo to Guaranteed Rate for sponsorship of today's webinar. Let's welcome Leonard Leventhal and DJ Dole to say a few words.
Thank you, Arlene. Thank you for the introduction. And good morning, everyone. It's always nice to be in front of you. It's nice to see a lot of familiar faces on the call, as well as some new faces to us. And either way, we appreciate your business, your support. And if you have any questions, obviously in the lending field, mortgage, anything, finance, please feel free to reach out. I'm going to use my small time this morning to, first of all, share a best practice with you, and as it relates to our presenter, Sue, this morning. And I've been very fortunate to know Sue for many years. And the one thing that Sue exudes is she, no matter how busy she is, and she's one of the most respected person in the insurance field, she always answers her phone, or she always calls you back immediately. So I would say, no matter how busy you are, I commend Sue for being that way for all these years. And it's a great way to run a business, and it's very simple. So I definitely want to share that and thank Sue for all she's done for us over the years with our questions and a lot of things that you'll hear during today's webinar. And then also, the other thing I'd like to mention, as we look at the way the world is getting smaller and smaller, for all of us now, we have contacts throughout the US in different states. Since we've been with Guaranteed Rate now, we have the ability to take on loans in basically all 50 states. So that has been a benefit to all of us, to any of you who have contacts in any of the other states. Both DJ and I can help to guide clients, even help them directly depending on the state. And that has been a really great blessing for us and a great tool for us to share with you and your clients. So please keep us in mind for all of the above, and we'd be glad to help. With that, I'm going to toss it over to DJ, and he'll definitely share some market updates and some best practices as well. DJ?
Thank you, Leonard. And I can't say anything more than Leonard already said about Sue. I've been in this business also for 22 years, and she was the first name that came up, I remember, in insurance, and always knows everything there is to know. So can't say enough about you as well. I just want to be brief. As you know, the rates have been crazy, going up and down, and I just locked somebody in yesterday with we thought, and everybody had expectations that the rates were going to go up today, and they did the exact opposite. We've got a really good program right now that really helps kind of avoid this. It's called the Lock and Roll program, and it allows your buyers to lock in for up to 90 days. If the rate fluctuates between that time, we can always adjust it, but it gives them the security of knowing that, you know, they're not going to lose what they have. If it gets better, it's always better for them, but it's something to really help people out in this environment. It's just, I don't know, I've been watching this and doing this for many years, and I really like this program. It doesn't cost anything, and it really does give them a little bit more security in what's been going on. So anyways, have a great class. I hope that information helps you out a little bit, and you can use that, and look forward to hearing what Sue has to say.
I'd like to return that and say, you know, I've been working with Guaranteed Rate and Leonard and the staff there, and you guys are very professional, and I've been happy to be that you have supported not only our leadership, but also supported me through my real estate transactions as well. I'd like to also introduce our book bar, our RRC REBI book club. We have a monthly book club called the Book Bar, and the next meeting will be live at Kala Powai Market in Kapolei on May 18th, 9:00 a.m. You must RSVP. Please see in the chat that there is an RSVP link. The Creature from Jekyll Island, a second look at the Federal Reserve. This was highly recommended, and I am excited to read this book. Next, we have a CRB course. Our next certified our next certified real estate brokerage management course, CRB, is scheduled for July 10th and 11th with instructor Robert Morris. The class is geared towards PBs and BICs and is entitled Exit Strategies for Brokerage Owners. You will receive credits towards a CRB designation and 6 elective CE credits. A link is in the chat box for more information. And our long-awaited REBI 24th Annual Golf Benefit, held Thursday, July 6th at Eva Beach Golf Course Club. Benefits, and this benefits Hawaii's Children Cancer Foundation. Be a sponsor deadline is February 28th, or be a player and get involved. I am so forward looking to this golf course, this golf tournament. And that also is in your chat box information. I am sorry, hang on one moment, just lost my. Next we have At Home with Diversity. And this is HAR, Hawaii Association of Realtors, is having a fire sale on their upcoming At Home with Diversity course. It is a NAR certified class that helps you maneuver through our diverse world and multicultural market. If you are a PB or BC, you want all your agents to take this course because it is a big risk reduction. This class is, normally is $79, but now it's $49, and that includes 6 elective credits, May 2nd and 3rd, virtually, and with Robert Morris, a dynamic instructor. Crystal will be dropping the registration link in the chat box as well for this. So don't forget to evaluate. And that will also be dropped in the chat box. Next, I would like to go ahead and introduce our special speaker. Sue Savio has been president and owner of Insurance Associates, Inc. since 1975. She is a past president of Hawaii Independent Insurance Association, Agents Association, and the Community Association, CAI, and has served on the board in different capacities since 2000. She was recently honored with the, you can correct me on this, Gorley Award for Distinguished Service to the CAI Hawaii, and currently serves on the board of 3 condo associations. Please join me in welcoming Sue Savio.
Thank you for having me. I would like to, first of all, thank the nice introductions I got from our 2 realtors, our 2 mortgage guys. Unreal, thank you. I do try to answer all emails, and I do come in early to get them done, and I consider that the greatest honor that somebody appreciates the fact that I do get back to you. So thank you so much. We're going to spend a lot of time today talking about 2022. It's a year in review. It is crazy things that are going on in condo land, and I do call it condo land. And it's going to take us probably a good 45 minutes or so to get through this all. So let's start. Okay, here's the biggest problem. Most of our condos, in fact, 91% of our high rises on Oahu were built before 1990. That means they're old, they're falling apart, they have issues. Okay, maintenance is the biggest concern. Now, there were no condos in 1950, but you see 56 of the apartment buildings or co-ops that were built back then were converted to condos, okay? And then in the 1960s and the 1970s, we can all remember what the LOI looked like. Building cranes all over the LOI from single family homes into high rises. So we have a huge selection of condos being built. Then Makiki, then we went out to Hawaii Kai, then we went out Eva. So there's a lot going on. But on the high rises, out of the 806 high rises that were built in Honolulu, 91% before 1990. It's huge, okay? So here's the issues we're going to talk about today. We're going to talk about property and the hurricane capacity. We're going to talk about sprinklers and pipes, very expensive. We're going to talk about umbrellas and how they've gone away. We're going to talk about directors and officers. And I'm sure you've all seen some articles recently about the nasty board of directors doing things to people in their complex. There's always two sides to every story. We're going to talk about flood insurance and what's happening there. We're going to talk about the HO6, which is the policy that unit owners need to have, whether they rent or live in it. And we're going to talk about the HO4, which is the policy that tenants need to have if you are a landlord. It's sort of a hash mash of everything in condo land is what we're going to spend some time on today. So first thing, property and something called loss creep. That sounds like a crazy term, but loss creep for insurance companies means that they know today's prices are not going to stay when they insure. For example, when COVID, just a month before COVID hit, we had a condo, single family home burn in Maui, and the price was going to be 2.7 to rebuild. No problem. We had it insured correctly. COVID came, building permit took over a year, supplies took another year. It finally just got done this month, and the price was $5.7 million from 2.7. No problem. We had it insured because we have what's called a blanket on our policy. So we have up to the total limit, but that is called the loss creep. When you insure something at one in 2022, but yet comes 2023, they anticipate that the rates, the construction costs in Hawaii will go up 20 to 30% this year. So insurance companies try to anticipate what it's going to be to make sure they're insuring to value, because inflation, the pandemic, lack of goods, supply chain interruptions, labor shortages, rising costs of construction materials, we've all been hit by that. Whether we go to the store and can't get what we want, or whether we try to order it and can't get it, we all get affected. So when a house burns or a condo burns, we have to be concerned at the cost to rebuild it, not the cost that it was insured at. So claims are costing more than initially anticipated because of what's going on in the property market. So right now there's tighter underwriting. The underwriters are very careful when it comes to condos. Okay, they have less capacity and they want to increase the rates. Okay, so that's what's happening. They say we can't write 100 million anymore. We can only get 50 million, or we have to buy more reinsurance. There's no new companies entering the Hawaii market. We have 3 standard markets that write our high-rise condos. You have Fireman's Fund, First Insurance, a company called DB. State Farm has some condos, but they're not writing new ones. So the few that State Farm has is fine, but that's it. So if you lose the standard market, because there's no new companies wanting to come in and write high-rise condos in our state, you're then going into the secondary market. And when you go into the secondary market, your premium could go up as much as 5 times. And it has happened to several condos in our state, and good condos, but have had losses or haven't done their pipes yet, or their sprinklers, had an issue and ended up in the secondary market. We are a very small market. We have only about 1,700 homeowner associations in our state. Okay, California has like 17,000. New York has 15,000. I think Florida's about in the same range, 12 to 13,000. Okay, there's a much bigger marketplace there. We're far out, we're harder to do business, we're more expensive when we rebuild. So we have poor loss ratios on our existing condos. Okay, the companies that write Fireman's First and DB have huge loss ratios. So they have done certain things that will affect 2023, such as higher rates, lower capacity on the hurricane, higher deductibles, which of course then affect the individual unit owner on his policy, and we'll talk about that. So we not only have a small market, we have poor loss ratio, we have non-sprinklered buildings, 300 of them, and our buildings are old. So the non-sprinklered buildings are a problem because when the Marco Polo fire hit, and we lost 4 lives, and then we had a few fires thereafter where we lost some lives, and we just recently had Lele Pono, where we lost a life in a non-sprinklered building. Every time there is a fire and there is a death, the insurance companies are paying out maximum limits. They're paying, Marco Polo paid out their 25 million umbrella, the 2 million on their general liability, the 2 million on their D&O. There's no way that you're going to get by without paying the total limits on your policy. So non-sprinklered buildings are a problem for the marketplace. They don't want them. They want you to put in sprinklers. So what's happening is, of course, between the sprinklers and the pipes, prices are getting outrageous because we have old buildings that need to put new pipes in, and that's all 800 and almost 800 buildings that need new pipes. So some have done it already. So let's go further. Hurricane. the capacity is very tight. When Ian hit, they estimated to be $60 billion in losses, okay? Out of the 50 largest reinsurance groups. Now, reinsurance groups are people who sell are insurance companies who sell only to other insurance companies. So if we take the Marco Polo fire, First Insurance, who wrote the business, had the first 4 million. They reinsured the other 106 million of the loss with reinsurance groups ahead of time. They had bought reinsurance on the complex that said, you have the next 20 million, 30 million, 50 million, all the way up to the 218 million that they were insured for. So they buy reinsurance and those carriers spread the loss for First Insurance. 2021 was the second most costly year ever for reinsurers. They paid out, it says 120 here, it's now been up to 144 billion, okay? Hawaii hurricane is a hurricane state. So our increase in ranges because of the hurricane is going to be anywhere from 30 to 100%. There are some condos who are going to see 100% increase in their hurricane rate, not because standard companies charging it, it's because the standards companies saying we can only write 25% or we can only write 50% of your hurricane. You have to go buy excess hurricane from someone else, and you're actually buying it from a secondary market. And that's what's increasing the premiums, which is increasing the maintenance fees for all of our condos. Hurricane is a severe problem. Okay, now the state came out with this life safety evaluation because after the Marco Polo, everybody, fire department, everybody was pushing for sprinklers, including the insurance company. Okay, but people said we can't afford it. And it's true, it's very expensive and it's a huge bite. So what most condos, they said, oh, if you pass the life safety evaluation, you don't have to put in sprinkler systems. Fine. But what happened to pass the life safety inspection, most people have to upgrade their fire alarm system. And it has to be audible. It has to have flashing lights for the deaf. It has to be loud enough. We get a pillow over your head, you can hear it. And it costs anywhere from about 500,000 to 1.5 million or more for your condo to do this. So most condos fail the LSC because they have the old fire alarm system that can barely hear. Sometimes it rings when it shouldn't ring. Everybody pays no attention to it. It doesn't go into your unit. It does into the sleeping area. So they didn't pass. So most failed. So sprinklers. Owners have to vote yes or no unless the board decides to go ahead and do it. If the board decides they want sprinklers, the owners can only say if they agree with the board, it's a done deal. Cost for Marco Polo was $5.2 million for them to put in their sprinklers. It took them 4 years to complete, including the design work. Okay, now granted, there was some COVID problems there with, they finished with getting the building permit. Building permits take a long time, and that really slows a lot of people up. But but you've got to design it. You've got to get it approved. You've got to go get a bid. You've got to go to the bank to borrow the money because nobody has $5.2 million sitting around. Insurance company, First Insurance is very good. They told Marco Polo after the fire, if you will prove to us that you will put sprinklers into your complex, we will renew. We'll give you 1 year to do that. So we renewed the policy after the fire in July. We renewed the policy in September for 1 year. First, the board went out and got a sprinkler quote. They were working on their loan. They were looking on almost had the contract signed. So I could give that to First Insurance, and First Insurance is still on their wrist today, okay? And you want to stay in the standard market because you don't want to pay 5 times as much. You want to use that money to buy sprinklers or to pay the loan off. So insurance companies today are keeping what they have, but they will not bid on any building that is not sprinklered. For example, in the old days, before Marco Polo, I could bid First and Fireman's Fund against each other to make sure I was getting the best deal. And they would bid as long as it was a good risk, they didn't have any losses, and they would offer me a quote. I can now take account to First or to Fund, and they say, no, thank you, no sprinklers, we're not bidding. We don't want it. They will keep what they have, but they don't want to take on more non-sprinklered buildings because of the cost of trying to insure a non-sprinklered building. The umbrella, D&O, and general liability rates are up for non-sprinklered buildings. In fact, umbrellas have almost gone away, all because you don't have sprinklers, okay? And sprinklers will become a necessity. Right now in 2033, all residential high rises are supposed to have sprinklers. We'll see if the building code gets adopted in Hawaii, because the building code we're in 2018, and the 2020 building code says that all buildings 3 stories and above or 4 stories and above must have sprinklers, residential condos. So we will see if it happens or not, but right now that's where it's at. Sprinklers, the push for sprinklers is because it saves lives, it saves water, and it keeps your insurance premiums down. Marco Polo used, I forgot what the fire department said, something like 660 million gallons of water. It was just astronomical, the amount of water for 6 hours that they put on that building. If it had sprinklers, they estimated it would have been like not even 10% of what they used in the water. And water is precious, okay? Sprinklers cost a hell of a lot more than LSE, I agree. So people are trying desperately to pass the LSE, but I'm trying to tell them as the insurance agent, you can pass the LSE, but you're gonna have to put the sprinklers in at one point in time. So why bother? Why not just go for the gusto and put the sprinklers in? But of course, you know, oh, we have elderly people on fixed incomes. And as I always tell them, yeah, they're on fixed incomes, but they're gonna leave that unit to somebody. And that niece, grandson, whoever's gonna get it, is gonna be thrilled to get a unit from grandma and grandpa until they find out that they're being assessed because now sprinklers are required. So it's something to think about. I try to make most people think of it that way. Okay, eventually sprinklers will be required even if you've passed the LSE, but for now you can pass the LSE and not need to do sprinklers. Whoops, what happened? Hit the wrong button, sorry. Umbrella, okay, here's why umbrellas are so bad, are so hard to get. We had the hotel shootings in Vegas, 751 million paid out in umbrellas. The Florida condo collapse, it was really 1.2 billion. Only 25 million of that 1.2 billion is a property, was the property policy that covered the condo itself that collapsed. The rest was all liability. Liability of the association, the umbrella, liability of the security guards who used to walk the grounds, their umbrella got involved. Everybody got sued who even touched that condo. The only person who didn't get sued was the contractor who was supposed to start the day after it imploded to fix up the building. Okay, that he's the only one that didn't get sued. But I tell you right now, if it was the day after he started, he'd have been involved in this lawsuit as well. And his umbrella carrier would be paying out. The Marco Polo fire had a 25 million umbrella. The Florida condo only had a 20 million umbrella. And yet 1.1 billion of that was liability. So everybody else's umbrella got involved. It was a big expense. So the umbrella carriers have kind of closed off and said, no non-sprinkler buildings. We want to see structural reports. And of course, their first fear is, oh my God, Florida, Hawaii, they're all alike. And I say, no, we're not built on sand. We're built on rock. Stay calm. We've not had a building collapse. We've had stairwells collapse and we've had lanais fall, but we haven't had our buildings collapse. So we're doing much better than Florida. Thank you. But it still is a concern. Okay. Directors and officers coverage. You know, I don't know why this thing keeps popping up. Do you see that? I apologize. Okay. Oops, one wrong. Okay, wait, hang on. Mistake. Okay, directors and officers. Hawaii has a problem. We did a slew of non-judicial foreclosures, 88 cases for our agency. The courts ruled against the associations and said you had no right to do this. So what happened was there was a class action suit, which didn't go anywhere, but the attorneys involved in that then sued all of these 88 condos, our 88 condos. Some of them did 10 non-judicial foreclosures. Some did only 1 or 2. And the umbrella carrier and the liability carrier had to, and the directors and officers policy has paid out on these claims, okay? And it's still not done. There are still, from the 2008 area, 2011, people coming forward to say, I lost my condo because of non-judicial foreclosure, I want to sue. So what has happened is the D&O rates have gone up, as have the premium, the deductibles. And most D&O carriers today are excluding any kind of foreclosure action. So today, if a board gets sued for something they did back in 2008, 9, 10, or 11, there is no coverage. And I actually have condos who are being sued for judicial foreclosure, non-judicial foreclosure done 11, 12, 13 years ago, and there is no coverage because the directors and officers policy is claims made, and the claim is made when the action was started, and the action for foreclosure was done 10, 12 years ago. So it's really a problem. It's such a bad problem that we used to have 5 main D&O carriers that were writing all of our directors and officers policies at a very competitive rate. 2 of them left Hawaii and said, we're out of here. Goodbye, adios. How done. Okay. We had 2 more come in, but they're very selective on who they're taking and being very careful because they saw what happened to the other companies that used to write our D&O. Flood. Rates have been based on the structure of the flood zone, the elevation, the foundation type, the year built. That's how it's been in the past. Then risk rating 2.0 came into town. It's a new thing from FEMA. It doesn't care about when you were built. It doesn't care about the elevation certificate. It doesn't care about your foundation type. What it worries about is the risk of storm surge, coastal erosion, which we have, distance to ocean, your replacement cost value. They still do look at your year built, but it's not taken into account very much, okay? For most people, it will be an 18% increase until you reach your full risk rate. For the average building, it's 5 years of an 18% increase. So they're going to actually have their premium double from what they're paying 5 years from 5 years later with this new risk rating. Grandfathering is gone. In the old days, oh, we were built and you were grandfathered and you were you didn't have to have flood then, so you don't have to have it now. That's gone. So there are carriers, companies, condos that have never had to have flood, but have to have it now. For a few, and I mean like a handful of our accounts, this was good, the risk rating 0.2, because it actually went down. But for most, it's going to be double over 5 years of what they're currently paying. So you have to so that the property managers are factoring this into the maintenance fees, which means maintenance fees are going to go up for flood alone, 18% each and every year for the next 5 years, which means it affects all of us who have to pay for our mains. Homeowners issues. Okay, so we've talked about the master policy. We've talked about how we cover as originally built. We cover fire, hurricane, all the perils we cover, and we have deductibles. So a homeowner's issues, there's two things. There's an HO6 for unit owners. I don't care if you live in it. I don't care if you rent it out. You're a landlord. You don't even live in this island. It doesn't matter. You're a homeowner. You can have an HO6, and you should have an HO6. Don't buy just the fire policy. Don't extend your homeowner's policy to your condo. It won't give you enough coverage. Go out and buy an HO6. An HO6 is specifically designed to take over where the master policy stops. Master policy covers as originally built. The HO6 covers upgrades by any owner. It covers the association's deductible that would be charged to you if your unit causes the claim. It covers your personal liability. So if someone gets hurt or you get hurt or you do something to hurt someone, you've got liability protection. It covers your loss of use or loss of rents. So you have a unit, they have a fire next door, your unit's trashed because of that, your tenant leaves, you have loss of rent, okay? Or you have to move out. It pays for unit like the Marco Polo fire. Hundreds of people had to move out. Their HO6 covered their loss of use so they could still pay because your maintenance fees are still due. Your mortgage is still due, okay? So if you have an HO6, somebody's paying you to go live elsewhere. That's what you want, an HO6. If you are a landlord, you should have an HO4 for your tenant. And you have the right to say to your tenant, I'm sorry, you can't rent my unit until I see your HO4, okay? And you want them to have at least a $300,000 liability. They're not going to cover the building because they don't own it. They're going to cover their contents. They're going to cover their loss of use. So if they set the place on fire, okay, and I've had tenants set the place on fire, you can then say, okay, tenant, you can still pay the maintenance, my rent, because you have an HO4 and they're going to pay that you live elsewhere. So your rent is still collectible. I had a landlord, the day that people were moving in, box after box after box, they put the last few boxes on top of the stove because it was filling up. They went down to get the last two, and guess what? When they put those last two boxes on the stove, they turned the stove on and set the place on fire. This was in Makiki years ago, $800,000 fire to the building, okay? The landlord just moved them in. You can bet your bippy they didn't stay there and say, oh, we signed a lease for a year, we owe you this rent. They were gone. They've lost everything, okay? But if the landlord had an HO4 on those people, he could have collected that rent while his unit was being rebuilt. Also, he could have charged the deductible that he got assessed to his tenants because it has liability on it, and they were liable for this fire. So just keep it in mind for you who are landlords, you are realtors that go out and handle people's rentals, you need to make sure that the tenants have an HO4. Today, the deductibles are outrageous and they are assessed to the unit owner who causes the claim. So if my washing machine leaks and I do $10,000 worth of damage to units below me and the association has a $5,000 deductible, I owe it, Okay, I'm going to get a letter saying we're assessing it to you. Today, $5,000 deductibles are rare. Right now, minimum is probably $25,000. I have a company that will not write a deductible less than $75,000, no matter how clean your condo is. We have condos in town, some very good ones or brand new ones that have 200,000, 100,000 deductibles. These are things that the HO6, the unit owner who owns in that condo, needs to make sure they have protection for. Because if the board assesses you $100,000 for a deductible, and you only have $50,000 worth of protection on your policy, on your HO6, you have to come up with the rest of that money. And I don't know about you, I'd rather spend a few $100s more on my homeowner's policy and have them pay it as opposed to me. So the HO6 is a very important policy that all owners need to have. All those of you who are tenants or rent out to tenants, HO4 is what you need to have. I can't, then they're not expensive policies, $400 or $500 a year. I mean, sometimes you can get them. I get a lot of calls from State Farm because their premiums are like 150. I don't know what they're getting for under $50, but I always tell people, what do you pay for your car insurance? Is not your condo worth more than your car? And you're paying more for your car than your condo? So it doesn't sound right to me. Are they protecting your deductible? Do they have you, you've got to make sure the policy you're buying isn't a boilerplate, but is for you and the condo you own, along with what you could be charged by your association. So again, make sure that you've got the right coverages. And this has been a big issue with homeowners, because when somebody says we have a $100,000 deductible now, and it used to be 25, I got to go out and put $75,000 more protection on my policy. And even though we send letters to the owners, even though the board puts it up in the elevator and they put it on their town square thing, you cannot imagine the number of owners who never read anything. And they have no idea until they have a claim that they're short $50,000, $75,000. It is not a pleasant telephone conversation. I like it much better when they say, yes, my homeowner's carrier covered it. Phew, much better. Okay. So the mighty HO6, and it is mighty. It's paid by for each owner to the insurance company of their choice. Nobody cares where you go, just go buy it. Buy the broadest policy you can find. Okay. What does it cover? Okay. Well, it covers what the master policy doesn't cover: upgrades, contents, deductible, loss assessment, loss of use, and your personal liability. We went over this. I can't stress to you how important these things are as to what it covers. Excuse me, I have a cough. So contents is your stuff. It's your furniture, your clothes, your bedding, pots and pans, dishes. You can't imagine how much your stuff is worth. I have people say, no, I don't have much, and then $10,000 they buy in contents. Then they have a loss and they realize how underinsured they are. It's an inexpensive policy. Throw a little extra on it, people, just in case you have the claim, okay? Dwelling is the building. It's the deductible plus your upgrades by any owner, past or present. You need to make sure you're insured correctly. Don't say, oh, I bought it, it came with a wood floor. Well, that's too bad. It came with carpeting at $3,000 and the wood floor is 10. You're only going to get carpet money from the master policy. Buildings built in the 70s and 80s was Formica. Remember Formica? Okay. Orange shag, long. Okay. Yellow appliances. Trust me, all of these units have been upgraded, and you need to make sure that you're insuring to value. HO4 is renters. It's their stuff. It pays the rent until their unit is ready, and it covers their liability for bodily injury and property damage. So when they set the place on fire, or they have a water leak, or they leave the tub running, whatever, it's going to protect you as the landlord, them as the renter. It's a great little policy. Make sure your tenants have it. Now, 514B 143 is the insurance section of our condo statutes, not our bylaws, not our governing docs that protect the condo, but the condo statutes for the state of Hawaii. And there's lots of changes from, we used to all be under 514A. It's gone. Okay, 2018, 514A went bye-bye, and we're all within 514B. The insurance section is 143. In there, it gives the board the power to assess the deductible. Now, it states the board, in the case of a claim for damages to a unit or the common elements, may pay the deductible amount as a common expense. Trust me, no board saves money, no condo saves money to pay deductibles. They intend to pass it off to somebody else, no matter what the cause is. So they can pay the deductible as a common expense, ignore number one. It doesn't happen except once in a blue moon. After notice and an opportunity for a hearing, they can assess the deductible against the owners who caused the damage or from whose unit the damage or cause of loss originated. So you're at work, you didn't do anything wrong, but somehow something backed up into your sink, overflowed, damaged 4 units below. It came from your unit. You're going to be assessed the deductible. If you have an HO6, if you have that HO6, you will get a letter and it will say right on the letter, turn this over to your HO6 carrier as you may have coverage. We don't ask you if you do, we just assume you do, okay? If we can't determine what unit it came from, it was a common element pipe that burst, but we found a kid's toy in it, and everybody in that stack has a kid. So we don't know who's shoved the toy down the toilet, okay? But it happened. So everybody gets a portion of the deductible. For example, Sue Savio, you were getting 30% of the claim money, you'll get 30% of the deductible. And Mary, who lives below you, got 10% of the claim money, she gets 10% of the deductible. And on it goes until we get to that 100%. Again, the deductible is spread to all owners. If you have the HO6, not a problem. If you don't have the HO6, it's out of your pocket. Okay? So, what did I? Whoop. So, excuse me. So, in conclusion, insurance costs are on the rise. And this year, we are anticipating a 30 to 40% increase because we also have to increase valuation. Claims worldwide affect Hawaii. We no longer are an island unto ourselves. What happens in California, the fires, what happens in Florida with the hurricanes, or New York with Superstorm Sandy, all of that affects us. Okay, so when you read about the huge tornadoes or the heat waves that are causing fires, we're going to get stuck with some of that expense because insurance spreads the risk, and the risk is spread throughout all of America. Okay, liability issues are a huge concern. Okay, liability issues are property damage, but even more so, bodily injury, claims to people's lives, whether the child that fell through the railings that are 8 inches wide and today are only allowed to be 4, or whether the child that fell out of a window because it was low, or off the balcony. Okay, we've had all of these claims, all right, with children, never mind claims with adults, but it really hurts when it's with children. So liability issues are a huge concern. Capacity to write large property is down. I don't care whether it's a shopping center that you need 100 million for or a condo that you need 100 million for. The capacity to write is down, and it's costing more money because insurance companies don't want as much of it anymore. I don't want 10 million. I'm only going to give you 5. Okay. And so I have to layer now even more, where before I maybe had somebody give me 50 million, and now they're going to give me 25 or 10. It's really difficult to get all the coverage you need. And on top of capacity being down, values are up. The replacement cost, not the real estate value, the replacement cost is up. Construction costs are up. The cost of concrete, wood, all of this is costing more. The cost of putting in appliances, cabinets, all of it's up. Okay. Reinsurance rates are up because there's been so much paid out in America. So for America, our rates are up. So is England's. This is almost like the industrialized countries are seeing the worst of it because we buy more insurance than anybody else. And all of the things above make our maintenance fees go up. And what bothers the insurance companies are maintenance fees are up, but you're not using it to maintain your building. As I tell board of directors, your job is to protect, maintain, and preserve the building. And if you're not capable of saying, gee, next year we have to raise our maintenance fees 30%, and the board says, oh, we can't do that, we're only going to do it 10%, you're only going to be more poho next year when you have to raise it 40%. So I always tell board, it's a job, and you've got to look at it as a job, and we got to keep our maintenance fees up so we make sure we have the money to maintain, preserve, and protect our building and the people in it. So in short, condo land is in turmoil, and that's what 2022 ended like, and 2023 has been hell on wheels. Questions? None? Did I blow you all over?
in the chat box. Okay, Wendy says, if a claim is made on HO6 policy, will insurance companies then cancel the policy?
Okay, the standard rule is 2 claims. Okay, on an HO6 before, they won't cancel, but they'll non-renew. So if you have 1 claim, that's no big deal. You have the second one, if sometimes insurance companies will go back to get it from the causative owner. So if they can get it back from the causative owner, maybe they'll just up your deductible from 500 to 1,000. But the average is usually 2 claims before they will non-renew. And then you will have to go into another market that will write, a standard market will write it. They write a lot of people who have had 2 claims or more, and they write it at a slightly higher rate, which is only fair because you've already paid claims, and with a slightly higher deductible. So it's not impossible to get the coverage. But would I file a claim for $100? No. You know, I would just eat it.
Okay, any other questions? Okay, no other questions. And I wanted to let everybody know a recording of this session and Sue's PowerPoint slides will be emailed to you later today. Also, I wanted to let you know that we want to hear from you. So a survey will be sent to your email as well. And I want to thank Sue very much for joining us today and sharing your mana'o with all of us. And a big mahalo. Thank you, Sue.
Thank you very much for having me. Truly appreciate the time.
That concludes our presentation for today. Thank you for coming and have a wonderfully blessed day. Aloha.
Aloha.